We made a video earlier this year where we did a forecast for the year, and we decided we would do a follow-up.
Yeah, so some of our clients kind of asked, one, are we maybe a little too positive? And the other thing they asked, what would it take to not have our forecast happen?
Mm-hmm. So we wanted to go explore that a little bit. So now that we're a little ways through 2021, Doug, how are things looking?
Well, we're still really positive. Now, it could, and I should make a side thing, it could fall apart if these variants of COVID become more difficult to deal with than we're forecasting, and the states or the federal government ends up closing down the economy again. All bets are off. It's not going to, we don't see the growth. But right now, with all the stimulus, last year we got $2 trillion in stimulus, and this year they just approved $1.9 trillion, and they're forecasting to have an infrastructure stimulus of another $2 trillion. So you're looking at $6 trillion coming into the economy.
Wasn't it more than $2 trillion?
$4 trillion last year. Or the base is $2 trillion, could go to $6 trillion.
Oh, okay.
Yeah, but right now they're talking $2 trillion. And realize 65% of the voters are in favor of this infrastructure spending.
Mm-hmm.
So, and I think it's both Republicans and Democrats. So I think it's going to go through. I think we're going to see this infrastructure spending. So one of the comments I got was, hey, what if it's spent in the wrong way? And the answer is, it doesn't matter. Money into the economy is money into the economy.
Mm-hmm.
And it's just going to make the market grow, the GDP grow, regardless where it's spent. And so we're forecasting probably about 6 to 8% growth of the GDP. Now, that we've never seen before. Not in my lifetime. It's usually 2-3%.
That sounds like a lot.
Most. It's an awful lot. So we really think that it's going to be very positive for the market. It's going to be very positive for the GDP. So we still maintain a very bullish outlook.
Do we see indicators of that growth yet?
We see a lot of it, actually. Of course, we've seen it in the market. At this time, the Dow is up close to 11%, near an all-time high. So we're seeing that kind of growth. We're seeing it in basically a lot of the areas that were closed down. For example, hotels are fully booked, and we're seeing it in the travel industry and restaurants. They're all starting, people are coming out and they're spending. And then the other thing is, last year the average household saved 12% of their income. I mean, normally they only save about 2%,
Mm-hmm.
2 to 4%. So they have a ton of money. They've paid down their debt. For the average, there are some people who are affected negatively,
Sure.
But for the most part, most people have actually done quite well with COVID and all the stimulus. And so they're in a better spot than they were before. They want to get out. They want to go traveling. They want to buy, you brought up another area. There's literally ships lined up trying to get goods into the United States.
Right, commodities.
Commodities, and non-commodities, like, for example, a good thing, we're moving our office, and we probably won't be able to get some of our furniture for a good 2-3 months.
Mm-hmm.
Some of the stuff, they were talking 24 weeks until they can get the stuff in.
Yeah, and I mean, you see the price of lumber and home building supplies have gone through the roof.
So you're correct. We've seen, that's something we do see happening is inflation. And so lumber is up over 300%.
Mm-hmm.
Oil is up over 80%. So we're seeing a lot of commodity prices skyrocketing. Yeah.
Mm-hmm.
And so that's the negative part. We see the inflation rate really taking off. And that's going to have a negative impact, especially on people on fixed income. We think interest rates were going to have to go up much sooner than the Fed is forecasting, and that's going to really hurt bond yields or bond principal because as interest rates go up, the value of your bonds go down.
But then equities will still be a big driver.
Yep. And equities will be the best place to be, mainly U.S. equities, but also some overseas equities. Also, there's one other thing. As the dollar goes down in value because of all the money that is being pumped into the economy, and realize the M2 money supply has grown by over 25% already, that's going to devaluate the dollar. And the biggest beneficiary of devaluating dollar is the emerging markets. So, that's another good place to be investing in emerging market stocks. It's not a good time for bonds, but it is a great time to be a stock investor.
At least for 2021.
For 2021.
Well, that's all that we have for today. Thank you so much for watching, and please let us know if you have any questions.
Thank you.